Welcome back, students who are taking financial accounting, and in this video we are working on the assigned homework problems from the digital study guide for chapter 7, the exercises group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Right, so we left off on problem 7-36, and it says here percent of sales and aging of accounts receivable allowance methods. Right, Outer Banks uses the allowance method for accounts to account for uncollectible accounts. On December 31st, the balance in the uncollectible accounts was $1,300 credit balance. Journalize the year-end adjusting entry for uncollectible accounts, assuming the following independent scenarios. So we have to treat one separate from two. Outer Banks estimates uncollectible accounts as 0.75% of net credit sales. Net credit sales for the year equals $800,000. And then 2, okay, based on aging of accounts receivable, Outer Bank estimates that uncollectible accounts will be $2,650. Right, so number 1 here, all right, sure, this here problem tells you that the instructions, if you actually look at this, you can get a hint that this is a percent of sales, and then of course the aging method. So you have the percent of sales method and the aging method. You're using both. Now number 1 here, let's say you didn't see this information and you're taking a test and all they give you is just this information. They don't give you this stuff here, right? Well, this is what, if you understand the concepts, when you read, the situation, if you understand the concept, you know which method to apply for that particular situation. It says here, Outer Banks estimates uncollectible accounts as 0.75% of net credit sales. Net credit sales for the year is equal to $800,000. Well, if you're using net credit sales, what method would you use in calculating your estimate of allowance for uncollectible accounts? Well, the percent of sales method uses the credit sales information. Aging method doesn't. So number 1, you're using the percent of sales method. And then of course number 2 here, it says based on the aging, because based on the aging, then you're going to use, for number 2, you'll use the aging method. So understand the concepts, and when you are presented the data, you use the most, the appropriate method. If you're, it's telling you flat out, your uncollectible accounts is $2,650. You can't just assume that that's the number you'll use for both methods. They are different. So let's see, number 1 here, right? We need to make a journal entry. So it says the estimate uncollectible account as 0.75%. All right, so 0.75% is 0.75. I'm sorry, 0.0075. Sorry about that. Because 0.0075. Remember, 1% is 0.01, right? 3/4 of that is 0.05, right? So it's 0.0075, right? 3/4 of it. So that's 0.75% of the net credit sales of 800,000. So if I have 800,000 and I multiply it times 0.0075, I end up with 800,000 times 0.0075, I end up with $6,000. So for number one here, my estimate is $6,000. So my journal entry for number one is I'm going to debit bad debt expense for $6,000, and I'm going to credit allowance, and I'm not going to write it out, allowance for uncollectible account of $6,000. Right, number two, based on aging of accounts receivable, Outer Banks estimates the uncollectible accounts will equal $2,650. Now, it's telling us that the uncollectible account will have a balance of $2,650. And up here it says the balance in the account was a credit balance of $1,300. Right? So we have to make a journal entry for the difference between the two in order to arrive at a balance of $2,650. So obviously $2,650 less $1,300 is $1,350. So that's what we're going to make our adjusting entry for. So I'm going to have a debit to bad debt expense for $1,350, and I'm going to credit my allowance account for $1,350. Okay. And so those are my journal entries for number one and number two. Okay, that was a little bit of a different kind of a problem, but still it's using the same concepts that we did in exercise 7-35B as far as calculating the balance that you need when you know what the balance in the allowance account should be. Here, using the percentage of sales method, remember, we would just credit the allowance for the $6,000, okay, and then because we're taking that as a percentage of the sale, right? So our balance, if we were doing number one, all right, our allowance account would actually have a balance of $7,300, okay, and the reason for that is because of we're taking that as a percentage of the sales, right? Whereas with the allowance method, we're actually using the receivables as an aging method and saying, okay, how much, based upon our receivables, not our sales, okay? The difference between the two, percentage of sales versus the aging of the accounts receivable, right? In the percentage of sales, we just say this is how much of this sales are bad debt, and that goes into the allowance account. And then as we write off the accounts receivable, because we know we didn't collect those sales, then we make the adjusting entry against the allowance. But when you're using the aging of the receivables, we're saying this is how much of the receivable. We're not looking at the sales, okay? And so we're looking and saying, okay, what the aging of the receivable is, and that's $2,650. So then we have to actually back into the other amount, okay? All right, I hope you understood that. Again, it's just understanding the concept. And like I said, if you don't understand, go back and watch the theory videos and work through some of the other problems. And if you still don't get it, then contact an instructor, because it is relatively easy. It just depends upon the information that you're given. Will determine what you're going to do. Okay. All right. 7-37. On July 31st, Texas Bank loaned $475,000 to Gina Baldwin on a 1-year 6% note. Right, 1. Compute the interest for the years ended December 31st, 2014 and 2015 on the Baldwin note. Round the calculations to the nearest dollar. Then 2, which party has a note receivable, a note payable, interest revenue, and interest expense. And how much in total would Baldwin pay the bank if she pays off the note early on January 31st, 2015. All right, I'm going to pause the video here, and since this is a note receivable, I'll just do this one in the next video.